Hi, everyone. This is Gary Wilson, and welcome to this week's live Path to Prosperity webinar. I appreciate you all being on board here. Tonight, we're going to go over a flip. Last week's webinar, we went over a rental and did some analysis on that using a couple of different calculators. We very rarely get flips like this. For some reason, it's always the rentals. Rentals tend to be a little more complex to analyze. Flips are quite simple. However, there's more risk with flips, okay? So we'll get into all that in tonight's subject. But really quick, just a little bit of housekeeping. Whether you're watching this live or in recorded mode, again, always please remember to look for the email the next day after a webinar. Follow the instructions in the email. Beverly's usually giving you information, updates, things like that to help you keep abreast of things. And also remember this, you get to choose what we cover in these webinars. So if you have something you want to go over, absolutely send it to me. It doesn't have to be a property. It could be any subject related to any of your training courses. I mean, welcome aboard if you're in the rental program or the flipping program or the investor agent program or the wholesaling program or the property manager program. Whatever it is you want to discuss, please let me know ahead of time. The further in advance, the better, because each day I'm usually in a different location teaching and I want to have time to prepare. So I got this actually from Clinton probably over a week ago. So thanks, Clinton, for doing that. In any case, and also you're in mute mode by default. You can please use your chat box to post questions or comments, okay? So first things first is if you could put in your chat box, just let me know that you can see my screen, which is now showing a picture of a property. And up above it says Atlas Development Group. If you can please let me know that you can see that, that would be awesome. So hang on one second. Yes, okay, so far so good. Okay, so I'm gonna go back to the email first. Let me go back to Clinton's email, okay? So this is a summary. Oops, I've gotta go here, there we go. All right, I should be able to see this because I think I shared this also. So this is a property in the Beverly Hills area of California, basically the greater LA Metroplex, okay? And Clinton's part of the project. He's a realtor too, so he's gonna profit multiple ways here. The property, they're looking for a 90-10 loan to value loan to do the job. All right. ARV looks like it's about 1.4 million. I'm going to define the ARV value here in a minute, so I just want to go through these particulars first. All right. It looks like the purchase price would be around $900,000, $899 to be exact. And currently the property should appraise at 1.1. In any case, the comparative market analysis CMA median sales price for Westlake Village, or Westside Village, because I thought this was Westlake, it's Westside, 1.62 million, okay? And they anticipate about 175 for the rehab. So let's go to the actual property itself, okay? And let's just scroll down here and see what we have. We got all kinds of good information. This is currently a 2-bedroom rancher with a garage you can see right there. And as you can see, Southern California, there's your grass. Just kidding, there's no grass there. So in any case, they believe the ARV is 1.4. I'm going to substantiate that for you here on tonight's webinar. And for those of you who are new or haven't yet dug into the material, ARV is a very commonly used term, and it stands for after repair value, ARV, after repair value. It's synonymous with what an appraiser might call a market value for a property, okay? It's not a range, it's a specific number. So ARV, plain language, guys, is really this. What should a property sell for in a fully marketable condition? In other words, no deferred maintenance, move-in condition, broom swept, and ready to rock and roll. Notice I didn't say anything about brand new this and brand new that. However, on a flip, you generally are going to have everything either be or look like it's brand new. So ARV, again, is in layman's terms simply what the property should sell for on the open market, arm's length transaction, nobody under distress, and the property's fully marketable. In other words, no deferred maintenance and move-in condition. That's probably the most elaborate, clear description that you can get. Okay, so remember that's 1.4. We're going to see why we came up with the 1.4. I just want to make sure everybody understands ARV. And by the way, just a quick pause here, guys. Being your teacher, I will tell you this. I've coached thousands of people on investing over the last, 2 decades. And this is one number that we don't budge on. We don't budge on, okay? This number has to be correct. Either you or your investor agent, your realtor, we call investor agents, or certified if you're an investor agent, has to, or both of you have to agree that yes, this is a valid number. It has to be based on facts and information, which I'm going to show you in a moment. Okay, so everybody clear on ARV. If you got any questions, I know the definition is pretty simple, but just know this number has to be accurate. And in fact, let me just dig into this a second. What would happen if your ARV that you project is too low? Well, what may happen is if you back up on a transaction, on a flip transaction, when you initially purchase the property and you believe the ARV is lower than what it should be, that means you're probably going to go low on your offers, okay, to buy the property initially, and you won't be competitive. People will beat you out. So that's one potential negative for having an ARV that's too low. The other potential is, let's say you get the property, then you go to sell it. Maybe the property is worth a lot more than you think, and you leave money on the table. So that's the downside of being low on your ARV. Now, what could the downside of being too high on your ARV be? And type in, guys, when I'm doing this, type in questions, type in answers. So I'll just ask you, if your ARV is too high, what risk might that create for the investor? Let's say the ARV you projected is 10% higher than it really should be for the market, okay? And because looks like some of you are typing in, well, here's the deal. What that means is you may actually end up paying too much for the property, okay? You may end up paying too much for the property if your ARV is higher than what it should be. And then later on, when you go to sell, you may find yourself pleasantly surprised that nobody's making offers on your property because it's priced too high, okay? Let me just check the answers here and see. Let's see. Hey, Lewis, do me a favor. Use the link to set up a strategy call with me. The link in the emails. If you could do me that, Lewis, that'd be awesome, because I need to talk to you about next week's webinar. I'm going to be driving back up to Ontario Friday afternoon. If you don't see a spot between now and then, Lewis, you've got my number. Friday afternoon, just call any time after 3. I've got quite a long drive. I'm going to be in Worcester, Massachusetts, so I'll have about a 9-hour drive, and I want to go over some stuff with you for Canada. Okay. All right, we got a message from Jeff. Hey, Jeff, you will pay 10% more if the other metrics are the same, and you're exactly right, Jeff, and possibly sell. Be overpriced on the sell. So thanks, Jeff, for keying that in. All right, now let's take a further look at this property, guys, and I'm going to go into the offer by the time we're all done here, what we call the MAO, maximum allowable offer. Okay, so here's a description of the property. We don't have to read all the verbiage here, but you can see what I went over earlier is repeated here. The investor believes the property should sell for 1.4. It says 1.399, but that's essentially 1.4. The rehab is going to be around 175,000. Okay, so let's look at the numbers here. So if we look at the after repair value 1.4 versus the initial purchase price of $899, you can see you basically got a 65% purchase price relative to ARV. In other words, you've got a 35% margin there to work with. And that 35% margin, you've got to account for your remodeling cost. You've got to account for your holding cost. So your holding costs, let's just say that includes cost of sale, commissions, and so forth, okay? So rehab cost as a percentage of the ARV is 12.5%. It's actually a little bit low, relatively speaking, but based on my knowledge of the area, LA, I'm out there quite a bit. Of course, I was just out there for about 5 months. That's not unusual. You're going to have a much higher cost basis, and rehab costs relative to cost basis is going to be lower out there. Okay. Any case, closing and holding costs about 1.26%. Remember, Clint is also an agent, so he's going to be participating as an investor, profiting, and also as an agent earning commissions. Okay, and he can contribute his commissions to the project. If I have time, I'll discuss that later. Total financing cost 4%. That's the cost of getting the financing. Okay. Total project cost basis 82%, which leaves you about 18% profit margin. Now, since we're at this point in time, let me go ahead and go over this with you. I want you to write on your notes the 3 letters MAO, maximum allowable offer. Okay? What we want you to assume right off the bat is this. Your profit plus overhead, we want you to take in profit is 20%. We want you to assume an overhead or carrying cost is 10%. Well, that combined figure is 30% of the ARV. So in other words, 1.4 million, if you knock off 30% from that, that's 300,000 plus another 120, that's 420,000 right off the bat. What that means is 1.4 minus 420,000 means you can't have any more than 980,000 into this property. Okay, total purchase plus remodeling. So now I just told you that the rehab is projected to be 1.75. Right. So what I'm getting at is that's why you have a skinnier profit margin here, minus about 2%. Also, there's some, I think, carrying costs may be a little bit low. But the bottom line is this. If you work with those parameters, you can't go wrong. Now, there are exceptions. So whenever you get into a really high-priced area, like where Lewis is, he's not that far from Toronto. Toronto is a very high-priced area. Toronto and Vancouver both are, like about $1 million on average for the average sale price. And that's not much. Believe me, I'm up there quite a bit. And little 600 square foot little, I don't even call them apartments. They're like efficiencies are going for 600,000. It's amazing. So in any case, in those higher priced areas, you're going to see smaller margins. It's just a natural mathematical fact of the thing. Wherever you're around an area where the average price is commensurate with the median range nationally, whether you're in Canada or the US, you should be able to command more like a 20% profit margin. Okay, always make that your benchmark. And if again, Vancouver, Toronto, parts of LA like Beverly Hills, San Francisco, Manhattan, in the States, you're going to have thinner profit margins. However, it's on a percentage basis. So heck, I'd take 10% of a $2 million project. That's $200,000 in profit. Okay, but here's the risk, and please write this down or remember it. The thinner your profit margin, the higher the risk, because if your project goes over budget, your remodeling project, that's going to cut into your already a thin profit margin. More importantly, on the back end when you go to sell, if your ARV has to be compromised at all, on the low side, you're cutting right into your profit. You may end up, I've seen this happen before. People walk away breaking even. All right, that's not a lot of fun when you spend 3 months on this thing. So in any case, here's what we're anticipating. All right, the flip profit about $180,000. Okay, return on investment during the life cycle of the project about 168% return on initial investment. Remember, they're going to be financing about 90% of this thing. Okay. So time to rehab about 2 months, time to complete sale about a month, and total time is projected at 3 months. That's a reasonable figure. We're out there right now. Days on market is right around 31 days. Okay, we just were out there, and that was a days on market, 31 days. I'll take that in a heartbeat. Okay, so here's pictures of the property. Okay, exterior pictures, you can see not much of a yard there, but that's typical for the area. The inside doesn't look too bad. You've got a walk-in shower stall with some grab bars, the old style porcelain sink that's attached to the wall. That's all going to go. Okay. The interior is actually not all that bad. But in any case, here's another view of the project. See, Clinton did this because he's looking for financing for the project. So in any case, he's anticipating having to pay some points on the loan that he's going to get. There's closing costs on the loan, holding cost, of course, the rehab, interest on the loan. All that gets added up, right? So total cash spent, 107,000. That's what he's going to have to, like, actual cash into the project. And total cumulative cost basis, you can see, is just over $1 million. Okay, sale price of 1.4, selling cost it's 70,000. Okay, that's most likely your commission. The profit, 181,000. So total cash committed. If you put in 107, all right, and you got out 181, that's not a bad return in a 3-month period. If you annualized it, that's where he's saying annualized at 674% profit margin. Most investors are just looking for the actual cash on cash return. In this case, 181,000 versus 107. Okay, not a bad day's work. In any case, there's more information out here. Here's comp. So this comes from the CMA. But first, let's go over the property. We can see we got 2 bedrooms, 2 bathrooms, 956 square feet, built 1940. Now, this property has a garage. So I went over this with Clinton. He's actually converting the garage to another room, which is going to make it a 3-bedroom, 2-bathroom rancher. Okay. Now, we also looked at the other properties in the area to see about garage, off-street parking in the garages. And in that part of the LA area, there's actually not a lot of garages. A lot of people have done conversions, in fact, to get more space. And if you're wondering why, all you got to do is just do the research on Beverly Hills schools, very highly rated. And in fact, I mean, there's the old show, not Beverly Hills 90210, going back to the 80s and 90s, I think it was. It's a very desirable school area. And believe it or not, people are paying $1 million plus. You can see right here, 1.2, 1.2, 1.5, 1.2, 1.6, 1.4. These are actual sales figures for 2-bedroom houses. There's only one 3-bedroom house there. And it went for 1.57. Okay. So in any case, when you add the garage in, he's going well over 1,000 square feet, closer to these latter figures here. So I think it was he believes will be about 1,400 square feet with the garage conversion. And you can see the sale price on that comparable, exactly $1.4 million. That's $1,000 a foot, guys. Okay, but that's the market out there. Remember, everything's relative. Some of you are freaking out because of these numbers. If you're living out there, this is what's normal. Okay, everything's relative. If you're living in, Dayton, Ohio, Macon, Georgia, I mean, this is going to be freaking out, right? But the reality is this is reality for the area. So in any case, these are the properties. Clinton and I went over this, and these are legitimate comps in the area, very close by. We also have some pretty close matches like the one I just showed you. Okay, so this is from Jeff. If you can, should you try to flip, if you can, in a higher priced area because you get proportionally more for a new kitchen and everything else, because granite costs the same whether it goes in a $1 million home versus a $500,000 home. So Jeff, good question. The answer is actually yes and no. Here's what I mean by this. The more money the higher priced area also increased risk. See, flip has some inherent risk involved with it. Flipping has inherent risk it's different than owning rentals. So owning rentals has its own set of risk. The big risk with the flipping is you essentially get one shot to make it right. And if you don't get it right, you really don't have anything you have to do to correct something is going to cost money. And every time you say yes to something being added onto your remodeling project, that yes is going to cost you some money. Now, so my theory is this. When I'm flipping homes, I want to be in an area where I want to know what is the median or average for the area. Now, Beverly Hills is one of the higher priced areas out there. There are areas in the greater LA Metroplex that are half of that. I would rather flip homes in an area where more people can buy them. That's my own personal opinion, Jeff. It's just my opinion. I would rather flip homes where more people can buy them, okay? Because I want to sell that property with certainty, have the greatest number of people looking at it, and sell it as fast as I can. When you go into the higher priced areas, you're reducing your market. In other words, the amount of people who are capable of buying that property is going to be reduced commensurate with the increase in the property value. So the higher priced property, the less people that can actually afford it, okay? Now, that's just part of that's fact-based, but my opinion is more people can afford a median price. And there's a handful, but you don't have to drive too far to go down to $500,000, okay? And you'll have more areas in the greater LA Metroplex at $500,000 than you will at $1 million plus. Around there, you're really looking at just over $1 million on even the C plus areas on average. So this is a little bit extraordinary. This is a little bit elevated relative to the area. So that's part of it. Now, the other part of what Jeff's asking, guys, is the cost of remodeling are relatively fixed, especially material costs. However, if you notice this project called for $175,000 project, right? Why do, Jeff, where you're living up there, heck, I could build a whole house for $175,000, right? The house itself, not the land, but the house itself, especially when it's a 2-bedroom bungalow. And we could build that for probably less than that, right? By the way, I know where Jeff is because I don't live too far from him, across the border in Canada. So in any case, so back to this. That's why I said the answer is yes and no. Yes, the fact that certain costs are fixed, it doesn't matter where you put in a window or a door, it's the same cost for the window or the door. But in the higher priced areas, labor costs are going to generally be a little bit higher, Jeff. Those plumbers, electricians, and the carpenters, they got to live too. And I know some electricians out there that actually do pretty good. So excellent question. In any case, so we've got our comps, okay? Now here's some pictures of the comps. And this one here, National Place, looks pretty good. That's the same street the subject property's on. Queensland looks pretty good. The 10757. So let's go look at National Place in Queensland, 10757. So 10757 is this one here. That's the 3-bedroom, 2-bath, sold for 1.57. In National Pike, sold for 1.2. So I'm going to go with this other one on Midvale. So let's see what Midvale shows us. I don't see a picture from Midvale. Sorry, guys. I wasn't provided in this information. But in any case, we got pictures on Glendon and the other Queensland. There's 2 Queenslands. So then the other Queensland's at 1.22, Glendon's at 1.205. So if you really, you're not supposed to do this, but if you average out 1.57 to 1.2, you're going to get somewhere around 1.4. But that's not what we do. Here's what we really do when it comes to flips. You have to think like an appraiser. I know most of us are not appraisers, but appraisers take of the properties that are provided as comps, they take the one that's the closest match to the subject property. In this case, it just happens to be the one at 1,400 square feet on Midvale Street, okay? Midvale Avenue, excuse me. So in any case, I want to show you something else here, so hang on just a second. I'm going to go to the material. This is in your training material. This section here is the MAO section, maximum allowable offer section in the flipping program. It's also repeated in the investor agent program. So if you're in the investor agent trainer program, you've also got this, okay? So in any case, this just kind of drives home the point that you have to have an accurate ARV, and you have to understand your how to arrive at your MAO. So in this subject, in the learning material, we just assume an ARV of $200,000, okay? And if we assume a 20% profit margin, like we discussed earlier, and a 10% margin for overhead, that's 30%. So right off the bat, we take 30% off of the $200,000. Well, if you do the quick math on that, that ends up being 60,000. In other words, 30% of 200 is 60. Subtract 60 from 200 and you're left with 140. So even if you had no rehab costs, the most you can pay for this property is 140 and still turn a profit, okay? Now, obviously there's gonna be rehab costs. So your rehab costs have to come off of the 140, and whatever that remainder is, that's your maximum allowable offer on the property. In other words, if your rehab costs are 20,000, you wouldn't want to offer more than 120 for the property. In most cases, you don't even want to offer that because you want to leave a little room for negotiating, okay? Now this leads me to the next subject here. In a market like we are right now, and I just want to tell you guys, you're on board from California to Massachusetts and Canada and everywhere in between. The market that we're in, and this is just my opinion based on data, and particularly from some very high up people, is that we are at or near the peak of a market. You can always tell anyways. Here's some rules of thumb that I want you to write down that you can gauge where we are in the market. Number one is when the lenders start loosening up and coming up with more creative loan packages, that's usually a pretty good sign that we're at or near the end of a market cycle, okay? And that is happening. It's been happening for a year or two now, okay? They're doing, blanket mortgages, or doing 100% finance, remodeling loans, home equity loans, things like that. They're basically just getting a little bit looser with their lending practices, okay? Because they're not making as many loans as they were the year before that, and then to compensate for that, they've got to be able to loan more money to more people, and the way they do that is they relax their standards a little bit. That's just part of it. The other part of it too is I know many of you have mentioned to me, hey Garrett, things really started changing. Last year there was a bit of a pullback, and there was in 2018. We noticed in most parts of North America, there was a pullback in the number of the volume of transactions. There were fewer transactions occurring than they were the year before. And also price escalation started to stabilize and level off, okay? So those two factors, like you have increased inventory, longer days on market, and more relaxed lending standards, it's pretty much inevitable we're at or near the end of a market. Just study all the old markets and you'll see you're seeing the same things when it comes to real estate, okay? Now, understanding that that's what's happening right now, what can we do with our flipping clients, or those of us who want to flip? Well, I'm going to give you a couple of strategies for you to write down. It's not anything you're writing here, okay? One of them is this, particularly when inventory is tight. So here's what's interesting. I just mentioned inventory is there's more inventory now than there was last year or the year before. But the fact is, relative to historical averages, it's actually still a little bit on the tight side, okay? It's just not, people just aren't selling. So what do? Here's what we do. If we don't have an abundance of foreclosures and bankruptcies and probate cases, decedents and divorces and landlord-tenant cases and things like that, in other words, people in distress, what we do is we identify the areas, the neighborhoods that are somewhat dated. Maybe they're built in the, post 1978, so neighborhoods built in the 80s, for example, where you've got a couple of properties in there that have not been remodeled or updated for quite a while. Typically, there are people who are in their 60s and their children are now grown and gone. They were going to school in the 80s, and now those kids are grown and they're married and have their own homes. And you have what we call the emerging retirees. They're not really distressed, but what they are is they perhaps got older kitchens and older carpeting, older floor plans that haven't been opened up and modernized. Those are the properties we look for. So you're not going to really get dramatic discounts, but what you could get is maybe a 10% discount relative to the overall market. Okay, so I'm just painting a picture here. So let's say you do that. You've done your homework and you found a couple of properties that relative to the other properties in the area are somewhat outdated, okay? You or your client can get that property for a little bit of a discount relative to market value. Well, here's what really savvy investors do, flippers. They understand that the market is moving. It's 30 days on market, like in Beverly Hills. Inventory is tight. they know that they can push the market by as much as 10%, let's say in this example. So what they're doing now is they're going to take a property that doesn't need major renovations. There's no really deferred maintenance. It doesn't need new roofing, doesn't need new siding, doesn't need new furnaces and things like that. What it could use is a facelift, okay? And so a couple of things to keep in mind. With a kitchen that has a good solid base structure, the base cabinets are solid and in good shape, they're just a little bit dated, you can replace the door and drawer fronts as well as the countertop, of course, and the sink. And all of a sudden that kitchen looks like a brand new kitchen, even though you kept the base and wall, the wall bases and the floor bases, and just replaced the door and drawer fronts as well as the knobs and the countertop and the sink. Just imagine what that kitchen would look like. So, matter of fact, if any of you have done this before, what I just described there, if you could just type in your chat box and let me know if you've seen this done before. It's basically a facelift, and it's a lot less expensive than replacing a kitchen, okay? Some other ideas. If you have an older floor plan where a dining room is walled off from the kitchen and that's also walled off from the living room, you can open up those walls, providing they're not load-bearing walls, and if they are, you can brace them and support them, and open up and make one big giant space. And people love that. You're modernizing a place without a lot of crazy costs. That's another example. Another thing I've seen is this: the use of bamboo. It's a very durable wood, man. I've seen bamboo ceilings. I've seen bamboo floors. Okay, it's durable. Bamboo's a durable wood. I have seen some walls that are like partly bamboo. I didn't really care for that. With the bamboo ceilings, what they do, guys, is this. They take out the drywall ceiling, open it up, raise it, and you've got a vaulted ceiling that's now lined with bamboo. It's an awesome, awesome effect. Okay, particularly when you're in an area that's somewhat tropical, like LA, for example, like Beverly Hills. That's another idea. Another idea is this. When it comes to decking and patios out back, let's say you have a dining room with just a window. In the same window cavity, you can take the window out, cut it down to the floor, and put in a slider or a set of French doors. And then what you do is you walk out level onto a deck. Maybe it's only 12 by 12, but walk out level to the deck. Make sure you remember that level. Then that would step down to the side to a lower level deck, maybe 2 or 3 steps down, and another level, maybe 2 or 3 steps down onto a patio, sort of like in a wrap-around effect. And the patio is like a stone, maybe fieldstone patio that's zero clearance, level with the ground. So now you just basically provided direct access to the outdoors without a lot of railings and stuff like that. It's easy on the eye. It's easy to navigate. It's open and spacious. It brings the outside in and brings the inside out. And people love that stuff, okay? And I'll give you a startling statistic here. What would you guess is the renovation or renovations that bring you the greatest return on your money? And just go with your gut. I know a lot of you are going to type in kitchens and bathrooms, which historically has been the most common renovation because it's, everybody loves a brand new kitchen, loves a brand new bathroom. But the actual answer is a little bit startling. So I just wanted to see if anybody guesses what it is, okay? And I kind of just gave you a hint, by the way. So whatever you think that is, the remodeling project that brings you the greatest bang for your buck, please give me a shout out and let me know what you think that is. Okay, and while you're typing that in, I'm going to go ahead and tell you. It's actually siding and decking. Siding, number one, brings the greatest return on investment. Go figure. It's written up. Statistically, that's what happens. We always think kitchens and bathrooms, which is definitely a good idea, but it turns out siding brings you the greatest return on investment. And then followed by decking, and then doors and windows and things like that. But kitchens and bathrooms are still big. So let me go to the chat box here and see if we got any comments and or questions. Let's see. Seen it done routinely in Massachusetts. Hey, PF, how you doing, buddy? Good to see you. Good to see you last week, too, when I was in Cambridge. Let's see. Hey, Helen, how you doing, Helen? Good to see you, too. How about that? Paint, windows, door to door. Hey, by the way, guys, I've got to give a shout out to Helen. Helen, when I'm going to send you a text later on and give you a formal thank you, but I got back to my hotel room at the end of the day today, and guess what I found out delivered to me at the front desk? Some homemade banana bread. I'm in heaven. So I'm going to be munching on that after the webinar tonight. So thank you very much, Helen, for doing that. So in any case, so Helen's right. Take down walls, provide outside access. Boy, I tell you what, that holds true to pretty much no matter where you are. So so keep that in mind. So right now, this project, I don't really know all that Clinton's doing to the property. I haven't seen the details of the project, but I'm pretty sure with a 2-bedroom bungalow, they're going to have to open up some walls and bring the outside in. The front yard looked pretty spacious. I would basically landscape it with stone and some shrubbery. I wouldn't worry about grass. I mean, I got to tell you guys, last winter was pretty wet out in Southern California, but the danger is when you have a wet winter season in California, it usually means you got more greenery during the spring, and unfortunately that greenery becomes fuel for the late summer, early fall fires that tend to pop up. Kind of a sad dilemma there. It's such a beautiful place, but in any case, it gets hot and dry there this time of year, and there's not going to be much green stuff. It turns gold. That's why they call it the Golden Hills of California. So in any case, thanks, Helen, for the feedback there. Okay, so back to the property. I think we pretty much looked at all the facts and figures. So here's what I'll do. Let me go back to the property real quick here. Let's see. There it is. So based on these numbers, I want you guys to type in your chat box and think of this in 2 ways. One way for yourself is an investor, and then think of this as you, the agent, working for an investor. So here's the property again. You can see front yard's pretty good size for that part of the country. Believe me, there's not much to these yards. There's the front, basically your profile, and with the garage, okay. It appears the house can be bought for, I think it's under contract currently for $899,000, $900,000. We have reasonable assurance. The ARV is 1.4. You got a project for about 1.75. So what that means is there's a difference of $425,000 between the purchase price, the remodeling, and the after repair value. So knowing what we just talked about tonight and what you have in your learning material, would you do this project? So I want you to tell me first, you as the investor, you would do it, yes or no. And if you could tell me why, that would be awesome, because we love to open up some discussion here. And the second answer would be, would you encourage your investor to do this project? And yes or no, okay? And it's okay if the answers are different. Maybe your motivation and your criteria for flipping is different to your clients. I mean, you might have your profit margin may be stricter for yourself than your clients are, or vice versa, okay? So let me give you a chance to type that in, guys. And we'll start to wrap up tonight's session here. So let's see what we got. Let's see what the answers are coming in. Bob Palmer, hey Bob, says, hell yes, big cash on cash return. You got it, brother. So Bob's from the Boston area, and I know some of these figures, Bob, are definitely more than Boston, but Boston's pretty high up there. You got in Boston, you've got a high percentage of renters, but you've also got in the Boston area, Metroplex area, higher than the national average home prices too. So you got a unique combination there where you can flip, and you can also build a pretty good rental business. And in your area, I believe condos would be a better way to go to pick up some rentals and do Airbnb. But great, good answer, Bob. I appreciate that. And yeah, I mean, who wouldn't want to pull in that kind of money on a cash-on-cash basis? Again, the profit margin on a percentage basis may be slimmer than what we teach, but remember I said everything is relative. So in those higher priced areas, yes, the percentage margin may be smaller, but the cash profit margin would typically be higher. And I'm okay budging 10% on that 20. I'll go down to 18% if I believe I'm going to make that kind of money. And we've done that. We had a flip we did up in, where was it? Up in Burlingame, California. It's part of the San Francisco metro area. In fact, how many of you have heard of Burlingame before? It's just south of San Francisco on the bay side, on the side of that peninsula that goes up there. And project was 1.8 to purchase, 2.3 on the sale. Okay, and we basically pocketed about 200 grand. In other words, we pocketed about 10%. And I mean, I was a little bit nervous on the outset, but turns out it worked out to be a pretty good deal. So in any case, Helen says she lived there. Actually, I think you maybe, did you tell me that? I can't remember, Helen, on a conversation last night. But the Bay Area, guys, boy, beautiful part of the country, amazing views, just a plethora of stuff to do. So if you ever get the chance to go out there, take a week. You got Monterey, my gosh, you've got Yosemite off to the east. Of course, the Bay itself, the city of San Francisco. There's so many, you know, there's so many things to do there. It's just an amazing, amazing place. In any case, Carmel, by the way, at the bottom end of Monterey, beautiful little town there. Talking about expensive, my gosh. In any case, let me go back to the pictures here and the information so you can see it all. So again, here's the numbers on the project, okay? Let me see if I can get all of this in view and a couple of pictures. Yeah, so let me get the pictures and the numbers so you can see that again. Before, if more of you want to type in your answer, go ahead and look at these pictures and then tell me what you think based on your instincts and what you've learned so far, okay? By the way, the driveway doesn't look so bad. I see a crack right here, but that's not that big a deal. We could easily remedy that. It definitely could use some landscaping. I'm not real clear on the pictures. I mean, the windows, excuse me. I can't really tell, but these may be the old original windows, just based on the way they look. I would probably replace them, unless there's some intrinsic value to the windows. Maybe they're classic, you know, casement windows, wind out and the glass is in good shape. It's nice and thick and whatever. I mean, there may be some logic behind that, but generally speaking, we will replace those. So that's the numbers in the pictures, okay? And here's the exit strategy with the actual numbers there, cash on cash, plus the percentage return on an annualized basis, okay? And these numbers are pretty good. I mean, they're, Clint did a pretty good job on this, guys. You know, I think there's enough of a margin there. You know, I'd like to see him pull this off. He's just looking for a little bit extra kicker. So here's what I suggested to him, by the way. You guys can write this down too. Whenever you're involved in a project, like your own flip or you're doing a joint venture with someone, you can always contribute your commission to the deal. So he's obviously going to get the commission on the purchase, and he's going to get the commission on the listing side on the back end, and potentially the buyer side there too. Well, that all can be contributed to the overall project, and your percentage of your return is commensurate with what you're kicking into the project, even though it's commission, it's just going to be earned versus actual cash up front. Another idea, guys, is you could partner with the builder, the contractor, and ask them to contribute. In other words, instead of you paying them and they only get the contractor's fee, they could be partners in the project, and their contribution is the remodeling. And if it's evaluated at 1.75, then 1.75 out of 1.4, you know, if you do the math on the difference between 899 and 1.4, and you do a percentage basis on the remodeling cost, then he or she would get a share of the profits based on the 175. Another great way to get a deal to go through, right, guys? By the way, you can also, I'll give you another neat trick and then we'll wrap this up. I know I keep saying this, but on the settlement sheet, generally speaking, you got the buyer has buyer's closing cost, the seller has seller's closing cost. If you're close on a deal and you're just can't quite get there and you're within a few percentage points, you can have the buyer, or you're the buyer yourself, you can assume the seller's closing cost. You can slide them over on the settlement sheet onto your side, adjust the price down, right? And then the benefit to you is at tax time, all of those additional costs you just assumed, you can take or deduct at tax time and take that expense then and get your, whatever your tax rate is, maybe 25%, recoup 25% of it. So if that 25% recouping of your tax burden is close to what the difference in price is, you just got yourself a deal by making one move It didn't actually cost anybody a dime. The seller gets their net, and it doesn't, no skin off their back because their tax burden is going to stay the same. And you may have just made an improvement on your tax burden and let you got the house too at the same time. So in any case, again, here's the comps. I'll show these for another couple minutes, and then we'll go ahead and wrap this up. If you have any questions, guys, now please use the chat box. Now's the time to type them in. And so we'll go ahead and turn off the recording here in a minute. And then, by the way, next week, so today is the 13th. Next week's webinar is on the 19th Monday. And in fact, the last two webinars for the month are the 19th, next Monday, and the following Monday, the 26th, okay? And by the way, for those of you who are new, we don't actually go over properties every single time. This was just kind of unique that this popped up just a week after we looked at one of the rentals from New England. So next week, we'll probably go into some content. And then again, the week after, we'll do the same thing. And I'll put out the September schedule to Beverly. I've got to look at my travel schedule and see where I'm going to be in Texas and the times of the classes and so forth. And we'll get out the webinar schedule for September for you. Also, we'll put out there some time slots on the Schedule Once scheduling system for September, and we'll be good to go. So in any case, guys, I think that's pretty much it. I appreciate you being on board on this week's webinar. I hope you like the subject. That's great to look at these properties and break them down and analyze them, give you some ideas for remodeling, some ideas for getting a deal to go through, and ways you can be creative with these profit margins, okay? So in any case, God bless you and your families. Thank you for being part of this, and thank you for giving me the opportunity to teach you. As usual, if you need anything, just please let me know. All right, guys, take care of yourselves, and we will see you next week. Bye-bye.